Namaste. In this video, we will discuss about India's 32 that talks about the financial instruments classification. Objective of India's 32 is to establish principle for classification of financial instruments as liability or as an equity instruments. India's 32 applies the classification of financial instruments with a perspective of issuers, not from the perspective of holders. It classifies the financial instruments among the liability instruments, equity instruments, or assets instruments, and it also classifies related interest, dividend, losses, and gains. Apart from the classification of financial instruments, India's 32 talks about the cases and circumstances where the financial assets can be offsetted with the financial liabilities. The classification of financial instruments in liabilities and equity is much more than accounting matter or matter of presentation, because the classification of financial instruments will have impact on the financial performance of an entity. For example, a financial instrument that is supposed to be classified as liability instruments is classified as an equity instrument. In that case, the payout to that instrument will be booked as a P&L item instead of distribution of the profit. So it may have impact on the financial performance of an entity, and apart from the performance, it will have impact on the key performance indicators of that entity, maybe debt equity ratio or earning per ratio, etc. Financial instrument is any contract that gives rise to financial asset of one entity. It may be in form of cash, trade receivables, investment in bonds and deposits, investment in equity instruments, or loans, receivables, etc. And financial liability or equity instrument of another entity. So one entity will have the financial assets and another entity will either have the financial liability or equity instrument. Financial liability may be in form of loans and borrowings, trade receivables, redeemable instruments like preference shares, etc., or guarantee given for repayment of debt upon borrower's default. In the definition of financial instrument, we need to focus on the word contract. The generation of financial asset, financial liability, or equity instrument is because of the contract. If there is any liability or asset that is generated apart from the contract, is not classified as a financial asset or financial liability. For example, liability for paying the income tax is not a financial instrument because it is a statutory liability, not the contractual liability. Similarly, the constructive obligation as per Ind AS 37 are also not financial liability because they are not generated because of the contracts. A financial asset is any asset that is either cash or equity instrument of another entity or contractual right to receive cash or financial assets or exchange financial assets or financial liability under favorable conditions, or it may be contract that may be or will be settled in own equity in case of non-derivative where entity is obliged to receive variable number of own equity instruments, and in case of derivative where it will be settled other than by fixed amount of cash, financial assets, or own equity. So if we look at the physical assets or right of use or intangible asset or prepaid expenses, these are not financial assets because they do not fall in any of these four categories, either cash or equity instrument or contractual right or to receive these things, and contractual where contract will be settled in own equity. All these four category of physical assets, right of use, intangible asset, or prepaid expenses, although they create an opportunity to generate an inflow of cash or another financial asset, but it does not give rise to a present right to receive cash or another financial assets. If we look at the prepaid expense category, it is to generate future economic benefits in receipt of goods or services rather than the right to receive cash or another financial assets. That's why these are not financial assets. Financial assets will be categorized only when the assets fall in one of these four categories. Financial liability is any liability that carries a contractual obligation to deliver cash or other financial assets or to exchange financial assets and financial liability under conditions those are unfavorable to the entity. And in case where obligation is going to be settled in own equity, in case of non-derivative, entity is obliged to receive variable numbers of own equity instruments, and in case of derivatives, it is to be settled other than by fixed amount of cash, financial assets or own equity. Similar to the financial assets, in case of financial liability also, deferred revenue or deferred or warranty obligations are not financial liability because the outflow of economic benefit associated with them is the delivery of goods and service rather than a contractual obligation to pay cash or another financial assets. So because of this reason, these two will not be classified as a financial liability. Equity is defined as a contract that evidences a residual interest in the assets of an entity after we deduct all its liability. So in Ind AS 32, main point is differentiation between equity and financial liability. The critical feature of differentiating between the equity and financial liability is the contractual obligation to deliver cash or financial asset. If an entity has the contractual obligation to deliver cash or financial assets, it will be classified as liability. And if entity does not have contractual obligation, in that case, it will be classified as equity instrument. Further, the holder of an equity instrument may be entitled to dividend or other distribution of equity. In that case, as it lacks the contractual obligation to deliver such distribution, it will be classified as equity instrument. When we differentiate between the equity or financial liability, we look for the contractual obligation to deliver cash or financial asset. This contractual obligation to deliver cash or financial asset may be imposed directly or it may be imposed indirectly on the entity. If entity does not have any unconditional right to avoid the transfer of cash or financial asset, the instrument will be called as a financial liability. There is lack of access to the foreign fund or approval for payment does not negate the obligation to classify the equipment as financial liability. Further, obligation that is conditional or counterparty to exercise rights or not to redeem the instrument will be classified as a financial liability. Another case is if entity can avoid the transfer of cash or financial asset by settling the non-financial obligation. This will arise when a financial instrument contains a non-financial obligation, and that must be settled if and only if the entity fails to make distribution to redeem the instrument. In that case, if entity can avoid the transfer of cash or financial asset by settling the non-financial obligation, this instrument will be classified as a financial liability. Another case is if entity has obligation to deliver cash or financial asset or its own share and the value of those share is substantially increased as compared to the obligation. In that case, it will be classified as financial liability. For example, an entity has taken a loan of 5 million from venture capital fund for a period of 5 years, and the contract contains that the entity after a period of 5 years either will deliver the corporate building to the venture capital fund or will return the fund with the interest agreed upon. And the value of the building at the end of the 5 years is substantially high. So the entity is obliged to pay the cash to the venture capital fund instead of the corporate building. So the obligation is such that the entity will be obliged to deliver cash or financial assets, although it has another option to settle the obligation to the non-financial means. So in that case, the instrument nature is of financial liability only. When we are classifying the transactions between equity instrument or financial instrument, and this transaction involves settlement in on equity, we need to check whether a rule for fixed is matched or not. If a rule for fixed is matched, it will be classified as equity instruments. For example, if it is settled by entity by receiving or delivering a fixed number of own equity shares or by exchanging a fixed number of own equity shares that does not have further consideration payable from point of view of entity, in that case the instrument will be classified as equity instrument. The problem arises in case of the foreign currency convertible funds. Here, if an entity has issued foreign currency convertible bond in currency other than the functional currency of the organization, in that case problem will arise. For example, if we have issued bonds for a amount of 100 US dollars, that will be issuing 100 bonds for $100. In that case, the value of dollar will keep on fluctuating, and it will arise, and question will arise whether the rule for fixed is matched or not. If we say that the criteria for fixed is matched, in that case the instrument will be classified as equity instrument. But if we conclude that the fixed rule is not matched, in that case the instrument will be classified as derivative and will be taken care by IND AS 109 and will have major impact on the P&L and the financial statements because of the valuation options. So in that case, the IND AS 32 says that in case of foreign currency convertible bond, the fluctuation of foreign currency will be ignored. If the price is fixed in any currency other than the functional currency of the organization, the fluctuation because of the currency will be ignored and the instrument will be classified as equity instrument. A financial instrument may contain some contingent settlement option where entity is required to deliver cash or financial asset in event of occurrence or non-occurrence of some future uncertain event, and those uncertain events are beyond control of holders or the entity issuers. In this case, the instrument will be classified as financial liability, and these uncertain event may be a change in stock market or consumer price index or interest rate or some achievement in future revenue, etc. There may be a number of such conditions, and if financial instrument carries these conditions, it will be classified as financial liability unless these conditions are not genuine or can be settled only in case of the liquidation of entity, or it falls under the exception rules. Except in these three cases, the financial instrument will be classified as financial liability. We need to determine whether the financial instrument contains both the liability or equity elements in it. If it contains both the elements, we need to classify and present it separately. When we are classifying both the elements, it does not change because of the likelihood of the conversion is changing, or if the it has been more advantageous or disadvantageous for the holder of the equipment to convert it. So these factors will not change the classification of the element of financial instrument. When we are evaluating the value of the financial instrument, in that case, first we need to determine the carrying amount of the liability by measuring its fair value as per IND AS 109, and the equity instrument will be the remaining amount of the financial instrument. While dealing with the presentation of financial instrument, at initial level, we need to classify the financial instrument either in category of financial liability or financial asset, or in the category of equity instrument. And this classification to be done based on the substance of the contractual arrangement instead of legal form. Substance and legal form are commonly consistent, but not always. Some financial instrument may take a form of legal form of equity but are liabilities in substance, and other may have combined feature of equity as well as the financial liability. For example, a preference share that provide for mandatory redemption by issuer for a fixed or determinable amount at a fixed or determinable future date will be classified as a financial liability instead of the equity instrument. If an entity reacquires its own shares, it will be called as treasury shares, and this will not be recognized as an asset and will be deducted directly from the equity. No gain or loss in P&L will be recognized on purchase, sale, issue or cancellation of these ownership. Transactions related to interest, dividend, loss and gains related to financial instruments transactions will be booked based on the classification of financial instrument. If the financial instrument is related to the financial asset or financial liability, it will be booked in P&L account, and if the financial instrument is related to the equity instrument, the expenses will be booked in equity. Similarly, the cost incurred in issuing or acquiring its own equity instruments are deducted from equity, and the costs that are incurred related to compound financial instrument that has both the component of financial liability or equity, it will be allocated to liability and equity accordingly. In case entity is having financial asset as well as financial liability from a single party, in that case Ind AS 32 prescribes that we have to present it on net basis. It may happen if an entity is selling the goods or services to another party, so it will be booked as a receivable in the party who is selling the goods or providing services, and another party will book it as a payable. And the another party is also supplying goods and services to the first party. In that case, it will be booked as a receivable and payable respectively. So in this case, Ind AS 32 prescribes that if we have legally enforceable right to set off and we have intention to settle it on a net basis, in that case, we must offset the financial asset and financial liability. This is all about Ind AS 32. We have discussed it in a summarized way. And if you have any questions or need any clarification, you may discuss or send message on the given WhatsApp number. Namaste.